Hey everyone, and welcome back to the channel. Today, we're diving into a topic that sounds complicated but is super relevant in our globalized world, IAS 21. The effects of changes in foreign exchange rates. First things first, what's the big deal with IAS 21? Imagine your company is based in the UK using British pounds, but you buy supplies from a company in Japan, paying in Japanese yen. The exchange rate between the pound and the yen changes every single day. IAS 21 provides the rules on how to record that transaction in your books and how to report it in your financial statements. It ensures that everyone is on the same page, making financial reports comparable and understandable, no matter where in the world you're doing business. To understand IAS 21, you need to know two key concepts: functional currency and presentation currency. The functional currency is the main currency of the primary economic environment in which a company operates. Think of it as the company's home currency. For a US-based company that mainly buys and sells in dollars, the functional currency is the US dollar. The presentation currency, on the other hand, is the currency in which the financial statements are presented. Most of the time, these two are the same, but not always. A company might operate in Mexico using pesos as its functional currency, but present its reports in US dollars for its American parent company. So, how do we actually handle a foreign currency transaction? Let's break it down with an example. Say our UK company buys goods worth 1 million Japanese yen on credit. On the date of the transaction, we need to record it in our functional currency, which is pounds. We use the exchange rate on that specific day. This is called the spot rate. Let's say the spot rate is 200 yen to 1 pound. The transaction would be recorded as a 5,000 pounds purchase. This is the initial recognition. Simple enough, right? Now, here's where it gets interesting. What happens at the end of the reporting period, say December 31st, if we still haven't paid that 1 million yen invoice? This is where we talk about monetary versus non-monetary items. Monetary items are things like cash, receivables, and payables, assets and liabilities to be received or paid in a fixed amount of currency. Our 1 million yen payable is a classic monetary item. IAS 21 says we must retranslate these monetary items using the closing rate, the exchange rate, at the end of the reporting period. Let's say the closing rate is now 180 yen to 1 pound. So, to recap, determine your functional currency. When a foreign transaction occurs, record it using the spot rate on that day. At the end of the reporting period, retranslate all your monetary items using the closing rate. Any gains or losses from this retranslation go directly to your profit or loss statement. It's a logical process that ensures your financial statements accurately reflect the company's position even when dealing with the ever-changing world of foreign currencies.